The market has got very pessimistic very quickly. And I'm wondering whether you think this is an overreaction. The yield we've seen at the front end of curves on both sides of the Atlantic this week has been brutal. Have we gone too far too quickly?
Well, I think that what market pricing currently reflects is a strong disconnect between sticky inflation on the one hand, which is supported by ongoing wage pressures, given the tight labor market in the US, and on the other hand, Fed rate cuts. And you mentioned the front end rally this week. US Treasuries 2 years down more than 30 basis points this week. And while we also acknowledge that the US Fed is now entering a more nuanced phase of curbing inflation, meaning less fighting, it will not cut rates in 2023, in our view.
You're painting a picture where equity markets and bond markets fall at the same time, Ann-Katrin. When do you think that starts to happen? When do we start to see that turnaround? Because at the moment we've seen equity markets being reasonably resilient. We've seen bond markets being bid. I wonder if we're going to get back into a position where both have the potential to fall at the same time.
Well, I generally would prefer to get rid of that notion of being bearish or bullish in equity markets or bonds as a general statement. I think in this new regime that we live in, that investors have to embrace, a new regime of higher market volatility, which has also played out in the first quarter of this year, it's more about looking for relative opportunities. Where do we see these in equities and bond markets right now? In equity markets, we continue to prefer emerging market equities over developed market equities, given the very diverging earnings trends. Earnings look too rosy in developed markets. Earnings do have potential for a boost in emerging markets given China's restart. In fixed income, looking at government bonds, for example, we continue to like the very short end in government bonds for income, while we still are underweight the longer end, given Fed mispricing in our view, given ongoing quantitative tightening, debt loads. So overall, a higher term premium that still needs to be priced by markets.